Supply and demand are fundamental concepts in market economics, serving as the backbone of how markets operate. Imagine walking into a bustling marketplace, where vendors are showcasing their goods, and shoppers are eagerly browsing. The interactions between buyers and sellers in this vibrant environment encapsulate the essence of supply and demand. At its core, supply refers to the quantity of a good or service that producers are willing and able to sell at various prices, while demand represents the quantity that consumers are willing and able to purchase at those same prices. Understanding these two forces is crucial for grasping how prices are determined and how resources are allocated in an economy. Let's dive deeper into the concept of demand. When we think about demand, we often consider the relationship between price and quantity demanded. Typically, as the price of a good decreases, the quantity demanded increases, and vice versa. This inverse relationship is known as the law of demand. Picture a scenario where a popular smartphone goes on sale. As the price drops, more people are likely to purchase it, leading to a surge in demand. Conversely, if the price were to skyrocket, many consumers would hesitate or even forego the purchase altogether. This behavior is influenced by various factors, including consumer preferences, income levels, and the availability of substitutes. Now, let's turn our attention to supply. The law of supply states that, all else being equal, an increase in price results in an increase in the quantity supplied. This means that as prices rise, producers are more motivated to supply more of a good or service to the market. For example, if the price of wheat rises due to high demand for bread, farmers may decide to plant more wheat to take advantage of the higher prices. However, it's essential to recognize that supply is not solely dictated by price. It can also be influenced by production costs, technology, and the number of suppliers in the market. The interplay between supply and demand creates what economists call the market equilibrium. This is the point where the quantity supplied equals the quantity demanded, resulting in a stable market price. Imagine a seesaw balancing perfectly in the middle. This equilibrium represents a state of balance in the market. However, markets are dynamic, and various factors can shift either the supply curve or the demand curve, leading to changes in equilibrium. For instance, if a new health study reveals the benefits of a particular fruit, the demand for that fruit may increase, shifting the demand curve to the right. As a result, the equilibrium price will rise, prompting producers to supply more of that fruit to meet the increased demand. Shifts in supply and demand can lead to various market outcomes. When demand increases and supply remains constant, we often see a shortage, where the quantity demanded exceeds the quantity supplied. This can lead to upward pressure on prices as consumers compete for limited goods. Conversely, if supply increases while demand remains unchanged, we may encounter a surplus, where the quantity supplied exceeds the quantity demanded. In such cases, producers may need to lower prices to stimulate demand and clear out excess inventory. Understanding these concepts also helps us make sense of real-world scenarios. Consider the impact of government intervention in markets, such as price controls. A price ceiling, which sets a maximum price for a good, can lead to shortages as suppliers may be unwilling to produce at the lower price. On the other hand, a price floor, which establishes a minimum price, can create surpluses as producers are incentivized to supply more than consumers are willing to buy. These interventions disrupt the natural equilibrium and can lead to unintended consequences. Moreover, external factors can significantly influence supply and demand. For instance, natural disasters can disrupt supply chains, leading to shortages and price spikes. Similarly, changes in consumer preferences, technological advancements, and shifts in the global economy can all impact the dynamics of supply and demand. The COVID-19 pandemic, for example, caused significant disruptions in various markets, leading to shortages of essential goods and a surge in demand for certain products like home exercise equipment and cleaning supplies. In addition to these dynamics, it's essential to recognize the role of elasticity in supply and demand. Elasticity measures how responsive quantity demanded or supplied is to changes in price. For instance, if the quantity demanded for a product changes significantly with a small price change, we say that demand is elastic. Conversely, if quantity demanded remains relatively stable despite price fluctuations, demand is considered inelastic. Understanding elasticity helps businesses and policymakers make informed decisions about pricing strategies and resource allocation. The relationship between supply and demand is not just a theoretical concept. It has practical implications for businesses, consumers, and policymakers alike. For businesses, understanding these principles can inform production decisions, pricing strategies, and marketing efforts. By analyzing market trends and consumer behavior, companies can better anticipate changes in demand and adjust their supply accordingly. This adaptability can be a significant competitive advantage in a rapidly changing market landscape. For consumers, awareness of supply and demand dynamics can lead to more informed purchasing decisions. Recognizing when prices are likely to rise or fall can help consumers time their purchases strategically. For instance, if a consumer knows that demand for a particular product is expected to increase due to a seasonal trend, they may choose to buy it before the price goes up. Conversely, understanding when a surplus may occur can lead to opportunities for bargain hunting. Policymakers also benefit from understanding supply and demand principles. Economic policies, such as taxation, subsidies, and trade regulations, can significantly impact market dynamics. By considering how these policies affect supply and demand, governments can create strategies that promote economic stability and growth. For example, during an economic downturn, governments may implement stimulus measures to boost demand, encouraging spending and investment to revive the economy. In conclusion, supply and demand are the heart of market economics, shaping the way goods and services are produced, consumed, and priced. By understanding these fundamental concepts, we gain valuable insights into the workings of markets and the behavior of consumers and producers. Whether we are navigating the complexities of everyday purchasing decisions or formulating economic policies, the principles of supply and demand remain central to our understanding of the economy. As we continue to witness the ever-evolving landscape of markets, these concepts will undoubtedly remain relevant, guiding us in making informed choices and fostering economic prosperity.